In 1998, a young hedge fund manager sat across from Charlie Munger and asked him why Berkshire Hathaway had never touched the hottest stocks of the decade. He probably expected something about valuation models or discounted cash flows. What he got instead was simpler and harder to hear. Munger told him that most investors lose money, not because they buy the wrong things, but because they can't say no to the wrong things. That idea, the discipline of refusal, is a big part of what built one of the greatest fortunes in American history, and it started with a list, not a list of what to buy, a list of what to avoid. No matter how exciting it looked, no matter how many people were getting rich off it, no matter how out of touch it made him feel at dinner parties, while everyone else compared their gains. This is the story of 5 things Charlie Munger refused to buy, even when refusing made him look outdated, even when it cost him money in the short run, and even when almost everyone around him assumed he'd lost his edge. Each refusal looked like a mistake at the time. Together, they explain most of his success. And the last one on this list is the one that trips up more people today than any other, because it's disguised as smart investing. Munger passed away in November of 2023. A few weeks short of his 100th birthday, he spent close to 7 decades compounding capital, first on his own, then alongside Warren Buffett at Berkshire Hathaway. Along the way, he was handed dozens of chances to get rich fast. Land deals, hot stocks, whole industries nobody understood yet. He turned almost all of them down, and not because he was naturally cautious. He wasn't. Earlier in life, he ran a construction company, took real financial risks, lost money more than once, and rebuilt from scratch. He said no to these opportunities because he'd built something rarer than raw intelligence, the habit of refusal. Most people study Munger for what he bought: See's Candies, Coca-Cola, the businesses that turned Berkshire into one of the most admired companies on the planet. But if you only look at the purchases, you're missing at least half the story. Munger said more than once that Berkshire's record was built as much on the mistakes he and Buffett avoided as on the decisions they made. A catastrophic mistake, compounded over 60 years, can undo more value than almost any single brilliant investment can create. That's not a motivational line, it's just arithmetic. A single bad call, made with enough capital or enough borrowed money behind it, can wipe out decades of careful gains in a matter of months. Munger grasped this earlier and more deeply than almost anyone else in modern finance, so he drew hard lines and refused to cross them. No matter how the world around him changed. Start with the first one, because it's the refusal that shocked people most in his final years. Munger refused to buy cryptocurrency, and he wasn't shy about it. He called it rat poison squared, riffing on Buffett's original line about Bitcoin being rat poison. Then turned the volume up further, describing crypto trading as somewhere between dealing in turds and dealing in freshly harvested baby brains. It made headlines. Some people wrote it off as an old man out of touch with the future. But underneath the colorful language sat a principle Munger had applied his entire life. Long before Bitcoin existed, he refused to invest in anything that didn't produce something of real value. Think about what owning a share of a real business actually means. Own stock in Coca-Cola and you own a claim on syrup turned into drinks, trucks delivering those drinks to stores, workers getting paid, and profits generated year after year from an ongoing, productive process. The value comes from output, from something real happening in the world. Munger's test for any asset was blunt. Does this thing create value for someone, somewhere through production or service? A farm grows food, a factory makes goods, a hospital heals people, even an insurance company, which sat at the center of Berkshire's success, produces something real, protection against financial ruin, priced and sold at scale. Crypto failed that test in his view completely. Its price didn't climb because it was producing anything. It climbed because more people believed other people would pay more for it later. Economists have a name for that, the greater fool theory. Munger considered it one of the most dangerous ideas a mind can fall for, precisely because for a while it works. Prices rise, believers get rewarded, skeptics look foolish, and that loop is exactly what makes speculative bubbles so hard to resist. Here's what most people miss about the crypto refusal. It wasn't really about crypto. It traced back to a habit he'd built decades earlier, when gold was the speculative obsession of its era. Which brings us to the second thing Munger refused to buy: gold. This one surprises newer investors, since gold has a reputation for being the safe, conservative choice, the opposite of a risky bet. But the logic tracks the same line as his crypto stance. And it actually came first. Gold sits in a vault. It doesn't grow. It doesn't manufacture anything. It doesn't hire anyone or pay a dividend out of operating profit. Its whole value proposition rests on the belief that during a scare, someone else will want it to. Munger, echoing a point Buffett has made in shareholder letters for decades, liked to point out that if you melted all the gold in the world into a single cube, it would just sit there doing nothing while a farm of equal value kept producing crops year after year, decade after decade, feeding people and generating cash the entire time. People who buy gold, Munger argued, are usually acting out of fear of currency collapse, fear of government mismanagement, fear of general chaos. And fear makes a poor foundation for a long-term financial decision because fear-based assets don't compound. They sit there waiting for someone else's anxiety to justify the price. He wasn't dismissing why people reach for gold during uncertain times. He understood the impulse. He just refused to build his own wealth on an asset whose value depended on other people's fear rather than on anything it actually produced. A pattern starts to show up here. Crypto and gold share the same root. Munger wanted to own things that did something, not things that were really just a bet on collective psychology. The third item on the list wasn't an asset class at all. It was an entire category of business, and avoiding it may have saved Berkshire more money than any single stock pick ever made. Munger refused to buy businesses outside his circle of competence. The phrase gets repeated so often in investing circles that it's lost some of its bite, so it's worth putting the weight back on it. During the late 90s, the dot-com boom was minting millionaires seemingly every week. Companies with no profits, sometimes no real product, were valued in the billions on nothing but the promise of future internet dominance. Berkshire Hathaway sat almost entirely on the sidelines, and Munger and Buffett were mocked for it publicly, in print, on television. Financial magazines ran headlines asking whether the two of them had simply lost their touch, whether their whole philosophy had gone stale in a new economy. Berkshire stock underperformed the broader market during this stretch, and shareholders got anxious. Try sitting through that, watching your peers celebrate paper fortunes while critics openly question whether you still know what you're doing. Very few people, professional or amateur, have the stomach for it. Munger's reasoning was almost stubbornly simple. He didn't know with any real confidence which internet companies would still be standing in 10 years and which would vanish. Honestly, nobody did, not even the people pouring money in with total conviction. The difference is that Munger was willing to admit the limits of his own knowledge and disciplined enough to refuse betting real money on a guess dressed up as certainty. He liked to say that knowing what you don't know matters more than being brilliant. Most investors get into trouble not because they're unintelligent, he argued, but because they overestimate how much they actually understand about a business, an industry, or a piece of technology. Then the bubble burst in 2000. Trillions of dollars in market value disappeared. Companies once worth billions on paper went to zero. Berkshire, the boring old company that refused to chase the trend, came out the other side largely untouched, still holding real businesses producing real profits. The refusal that had made Munger and Buffett look foolish for 2 straight years suddenly looked like genius. It wasn't genius in the way people assumed, though. There was no secret prediction pinpointing when the bubble would pop. It was just the discipline to say, I don't understand this well enough to risk my capital on it, and to sit with looking old-fashioned while everyone else cashed out on paper. That's worth pausing on, because most people think great investors are defined by superior predictions. Munger would say the opposite. They're defined by admitting what they can't predict and refusing to gamble on those blind spots no matter how much social pressure builds up to do otherwise. The fourth refusal quietly costs ordinary investors more over a lifetime than almost anything else on this list, even though it rarely makes headlines. Munger refused to buy financial products loaded with high fees. That includes actively managed mutual funds charging steep annual fees for mediocre performance. It includes hedge funds built around the 2 and 20 model, 2% of asset charges every year regardless of performance, plus 20% of any profits on top. It includes complex products sold by brokers who earn a commission whether or not the product actually helps the client. Munger described a lot of the asset management industry in terms blunt enough to make compliance departments nervous. An enormous amount of money flowing every year to middlemen whose main skill is convincing clients they've earned a cut, whether or not they've actually beaten a simple, low-cost alternative. Here's the number that makes this refusal matter, and it isn't a Munger quote, just compounding math applied to his principle. A fee that looks small in any given year, say 1 or 2%, sounds harmless on its own. Compound that over 20, 30, 40 years, and it can eat a shocking share of an investor's lifetime returns. Munger understood, well before it became a mainstream talking point, that fees are one of the few variables an ordinary investor can actually control with total certainty. You can't control what the market does next. You can't control interest rates or recessions or the next geopolitical shock. You can control how much of your return you hand over to someone else for the privilege of managing your money. His own investing was famously concentrated and low turnover. A small handful of businesses he understood deeply held for a very long time, rather than paying for constant activity dressed up as sophistication. He thought a lot of the financial industry survives by convincing people investing is more complicated than it is, because complexity is what justifies the fee. Simplicity, held with discipline, usually doesn't, and this wasn't about being cheap. By the end of his life, Munger was worth well over $2 billion. He just recognized that unnecessary costs are one of the most reliable ways to destroy wealth, and refused to feed that machine even after it became completely normal for everyone else to. The fifth refusal is the deepest one, and it explains the previous four, because it isn't really about an asset class either. It's a mindset. Munger refused to bet on borrowed confidence. He avoided heavy leverage, refused to bet borrowed money on speculative outcomes, and wouldn't let debt amplify decisions that hadn't already earned his conviction on their own. This part of his philosophy is underrated. Over the decades, he watched brilliant, highly educated people wreck themselves financially, not because their thesis was wrong, but because they'd borrowed so much money that a small, temporary downturn wiped them out before the original idea had time to prove itself. He pointed to long-term capital management, a hedge fund run by Nobel laureates in the late 90s as the textbook case. Their models were sophisticated, and their reasoning was, in a lot of respects, sound over the long run, but they leveraged so heavily that a short-term disruption their models treated as almost statistically impossible was enough to collapse the fund and force a coordinated bailout from major Wall Street banks to keep them taking the broader system down with it. Munger's takeaway was blunt. Being right eventually doesn't help if leverage forces you out of the game before eventually arrives. He liked to say three things: ruin people in finance, liquor ladies, and leverage, using the alliteration on purpose so it would stick. Of the three, he thought leverage was the most dangerous for a serious investor because it turns a survivable mistake into a fatal one. Without debt, a bad investment costs you money and time. With enough debt, a bad investment, or even a good one that simply takes longer than expected, can wipe you out completely, with no chance to come back and try again. That's part of why Berkshire, even as it grew into one of the largest companies on earth, stayed remarkably conservative with debt compared to a typical American corporation. Munger and Buffett wanted to survive any environment, including ones nobody could see coming, so they'd always have capital ready when a real opportunity showed up. This isn't the mindset of someone racing to get rich. It's the mindset of someone trying never to get forced out of the game in the first place. Cryptocurrency, gold, businesses he didn't understand, high-fee products, and leverage dressed up as confidence. 5 refusals spread across more than half a century of decisions, and together they shaped one of the most respected investment records in modern history. What ties them together is the part you can actually use. Whether or not you ever buy a single share of stock, Munger didn't refuse these things because he predicted the future with unusual accuracy. He built a personal filter, a set of standards, and applied it with total consistency regardless of what was fashionable, what his peers were doing, or how much money other people appeared to be making in the moment. Does this produce real value, or does it depend on someone else's future belief? Do I actually understand this well enough to have genuine conviction, or am I just caught up in the excitement? Am I paying a fair price for something real, or feeding a system built to extract fees no matter the outcome? And if I'm wrong, does this cost me money, or does it have the power to remove me from the game entirely? Before I get another shot, that last question might be the most useful idea in this whole video, because it reframes what risk actually means. Most people measure risk by how much money a bad decision could cost them. Munger measured it by survival. A loss you can recover from is just the cost of playing a long game. A loss that removes you from the game entirely through excessive leverage or plain overconfidence is a different category of danger because it costs you time as well as money, and time is the one thing compounding cannot do without. You can't compound wealth or knowledge or a skill if you've already been forced out of the arena. There's a quieter lesson buried in all of this. Saying no feels passive, because refusing something rarely makes for an exciting story in the moment. Nobody throws a party for the stock they didn't buy, but refusal held consistently over decades is one of the harder, more active things a person can do because it means resisting social pressure, resisting the fear of missing out, resisting the temptation to lower your own standards just because everyone around you seems to be winning by ignoring theirs. Munger lived through several speculative manias in his lifetime. He watched people get rich, sometimes very rich, off exactly the kinds of assets and behavior he refused to touch, and it never shook his framework. He wasn't immune to doubt either. By his own account, stretches like the late 90s tech boom were genuinely uncomfortable, even embarrassing to sit through while refusing to participate. But he understood something most people never fully absorb. Being embarrassed for a year or two is survivable. Getting wiped out isn't. The people who build wealth that actually lasts are rarely the ones who said yes to every opportunity in front of them. More often, they're the ones who built a clear, honest set of standards and held that line even when it looked foolish in the short term. Munger didn't get rich by chasing every rising asset of his era. He got rich, stayed rich, and helped build one of the most admired companies on earth by knowing exactly what he wouldn't buy and refusing to negotiate with himself about it. Decade after decade, no matter how loud the noise got, that's really what Munger left behind. Not a stock tip or a formula, but a framework for saying no. Applied patiently and consistently enough that the yeses, when they finally came, were almost always right. If this changed how you think about your own decisions, money or otherwise, consider subscribing for more videos on the ideas of history's sharpest thinkers, and drop a comment if there's a mental model or investor you'd like broken down the same way. Munger spent a lifetime proving that the most useful word in finance, and maybe in life, isn't yes, it's a stubborn, unglamorous, repeatedly used no.